Let's be honest. We've all had our fair share of fun building our dream homes in the game called The Sims. Don't worry, there's nothing childish about it. We understand that you may be facing a dilemma between filing for a home mortgage or a housing loan, and it's important to recognize that there is indeed a significant difference between these two options. Stealth Wealth Society aims to provide you with a comprehensive understanding of the distinction between these two options. But before we delve into the details, be sure to click the subscribe button to stay updated with our latest financial videos. These valuable resources will assist you in mastering the art of stealth wealth. A home mortgage refers to a loan provided by a bank, mortgage company, or another financial institution specifically intended for the purchase of a residential property. This property can be a primary residence, a secondary residence, or an investment property, as opposed to commercial or industrial real estate. In a home mortgage, the borrower, who is the owner of the property, transfers the title to the lender under the condition that the title will be returned to the owner once the final loan payment has been made and all other mortgage terms have been fulfilled. Understanding the mechanics of a home mortgage. Home mortgages offer a broader opportunity for a wide range of individuals to become property owners, as they don't have to provide the entire purchase price up front. However, since the lender holds the title as long as the mortgage is active, they possess the right to foreclose on the home and sell it on the open market if the borrower ever fails to make the required payments. A home mortgage can have either a fixed or floating interest rate, which is paid on a monthly basis along with a portion that goes towards reducing the principal loan amount. With a fixed rate mortgage, the interest rate and periodic payment remain consistent throughout the loan term. On the other hand, an adjustable rate home mortgage features a variable interest rate and periodic payment that can fluctuate. Generally, adjustable rate home mortgages come with lower interest rates compared to fixed rate mortgages, but the borrower assumes the risk of potential interest rate increases. As the homeowner gradually repays the principal amount over time, the interest is calculated based on the reduced loan balance. Consequently, future mortgage payments make a greater impact on reducing the principal rather than merely covering the interest charges. Let's talk about the types of mortgages. When it comes to purchasing a home, borrowers have various options in terms of mortgage loans. These loans can generally be classified into three main categories: conventional loans, federal home administration loans, and specialty loans. I'll explain conventional loans. Conventional mortgage loans are not associated with a specific government program. They can be categorized as conforming, adhering to mortgage regulations set by Fannie Mae and Freddie Mac, or non-conforming. For conventional loans with a down payment of less than 20%, private mortgage insurance may be required. In May 2023, there were changes to upfront fees on Fannie Mae and Freddie Mac home loans. Home buyers with higher credit scores, such as 740 or above, saw increased fees, while those with lower credit scores, such as below 640, experienced reduced fees. Additionally, the down payment amount now influences the fee. Higher down payments lead to lower fees, but the credit score remains a determining factor. Loan level price adjustments by Fannie Mae can be found on their website. What about FHA loans? FHA loans are mortgage loans provided by private lenders and backed by the federal government. Key features of FHA loans include lower credit score requirements and lower down payment requirements. It is possible to be approved for an FHA loan with a credit score as low as 580 and a down payment of 3.5%, or with a credit score as low as 500 and a down payment of 10%. Let's talk about specialty loans. Specialty mortgage loans encompass those that do not fall into the conventional or FHA loan categories. This includes U.S. Department of Veteran Affairs loans, designed for veterans and their families, and the U.S. Department of Agriculture loans, allowing eligible borrowers in rural areas to purchase homes with no down payment. Before embarking on the journey of purchasing or constructing your dream house, it's advisable to prioritize financial planning to ensure a smooth and well-prepared approach. Stealth Wealth Society offers an all-inclusive personal finance course priced at just $97, designed to assist you in mastering the art of wealth in stealth mode. However, there's an enticing offer. You can obtain a complimentary copy of our personal finance ebook by accessing the link provided in the description. Here are the components of a mortgage payment. A typical mortgage payment may encompass 4 essential costs. The principal. The principal refers to the borrowed amount that you are obligated to repay to your lender. The interest. This represents the primary expense incurred for borrowing money from the lender to purchase the home. The mortgage insurance. Mortgage insurance is designed to safeguard the lender in the event of loan default. Whether this cost is applicable or not depends on the loan type and the size of your down payment. Let's not forget property taxes and homeowners insurance. Lenders often consolidate your property tax payments and homeowners insurance within your mortgage payment. A portion of your monthly payment is allocated to an escrow account to cover these expenses. It's important to note that these costs are distinct from upfront fees associated with purchasing a home. These upfront fees include earnest money, down payment, appraisal and inspection fees, prepaid fees, and closing costs. Now for the biggie. How to get a home mortgage. In order to secure a mortgage, individuals seeking the loan must undergo an application process and provide their financial history to a lender. This is necessary to demonstrate the borrower's ability to repay the loan. At times, borrowers may seek assistance from a mortgage broker to help them choose a suitable lender. The mortgage process entails several stages. Initially, borrowers may opt to get pre-qualified. This involves furnishing a bank or lender with a comprehensive overview of their financial situation, including income, assets, and debt. The lender reviews the provided information and offers an estimate of the borrowing capacity. Pre-qualification can typically be completed over the phone or online, often without any associated costs. The subsequent step is to obtain pre-approval, where the borrowers must complete an official mortgage application and supply the lender with all the necessary documentation. This enables the lender to conduct a thorough evaluation of the borrower's financial background and current credit rating. Upon pre-approval, the borrower receives a conditional commitment in writing, specifying the exact loan amount approved. This allows the borrower to search for a home within or below the indicated price range. Once a suitable residence is found, the final step is securing a loan commitment. A loan commitment is issued by a bank only after approving both the borrower and the chosen property. This indicates that the property's appraisal aligns with or surpasses the sale price. Upon reaching an agreement on the terms of the home mortgage, the lender places a lien on the property, using it as collateral for the loan. This lien grants the lender the right to take possession of the house in the event that the borrower defaults on repayments. Let's understand mortgage terms and cost. Mortgage terms refer to the agreed-upon conditions that dictate how you will repay the loan to your lender. Typically, a mortgage term spans 30 years, although certain mortgage loans may have varying terms ranging from 10 to 25 years. For instance, a home equity loan used to access your equity might have a repayment term of 10 years. Within mortgage terms, the interest rate you pay for the loan is a crucial factor. Let's consider an example. Suppose you borrow $300,000 to purchase a home and opt for a conventional 30-year loan. Based on your credit scores and other financial factors, your lender offers you a 3.5% interest rate. Additionally, you make a $60,000 down payment and allocate $200 per month for property taxes and $100 per month for homeowners insurance. The interest rate and the duration of the loan determine the overall cost of your home. In this example, your monthly loan payment would amount to $1,377.71. Over the course of 30 years, you would pay $147,974.61 in interest, $72,000 in taxes, and $36,000 for insurance, resulting in a total expenditure of $495,974.61. It's important to note that this calculation excludes the down payment. You ask, is a mortgage the same as a home loan? A home mortgage is a form of financing specifically designed for purchasing a residential property, typically a house. In this financial arrangement, the house serves as collateral, providing security to the lender. This means that if the buyer failed to meet their repayment obligations, the lender has the legal right to initiate foreclosure proceedings. Foreclosure enables the lender to take possession of the property to recover their outstanding debt. It's worth noting that the terms mortgage and home loan are often used interchangeably, but they do have subtle distinctions. Broadly speaking, a mortgage represents a loan that is obtained to acquire a piece of property, with the property itself acting as collateral for the loan. On the other hand, a home loan is a specific type of mortgage that is used explicitly for the purpose of purchasing a house. Therefore, while all home loans are mortgages, not all mortgages necessarily pertain to the acquisition of a residential property. Mortgages can also be utilized for purchasing other types of real estate, such as commercial buildings or vacant land. However, when discussing a home loan, it specifically refers to a mortgage that is secured to finance the purchase of a residential house. The required credit score for buying a house. Determining the specific credit score required to buy a house can vary based on the type of loan and the specific requirements set by the lender. For instance, if you're considering a Federal Housing Administration loan, it is possible to secure financing with a credit score as low as 500. However, if you opt for a conventional loan, the lender may mandate a credit score of 620 or higher as a prerequisite. It's essential to note that these criteria can differ from one lender to another. Acquiring a home mortgage is likely to be one of the most significant loans you'll ever obtain, especially when it comes to purchasing a house or rental property. Before taking on significant debt to build a house, it's worth considering the option of saving a portion of your income, practicing effective financial management, and embracing a lifestyle that aligns with living below your means. In fact, we have a video titled Benefits of Living Below Your Means. Discover these frugal lifestyle tips that we believe can provide you with valuable insights. Feel free to check it out, as you may find a lesson or two that resonate with your financial goals. Till next time.